In this video, I'm going to show you exactly how things like this can happen to banks in the US and around the world, really. So without further ado, let's just get right into the video. Go back here. I've got some money here, some movie prop money. And by the way, if you could share this on social media or, do anything to get this video out there, I would really appreciate it because I'm not sure the algorithm likes this kind of content, but we'll find out about that. But we got some money here. Let's go over how this actually can happen in the banking system. By the way, this is prop money. Just throwing that out there. But got around, I don't know, something like 200 grand of prop money here. So you go to the bank and go, hey, I got 200 grand. You FDIC insure this, right? For it's under $250,000. So it's insured, right? We'll go over that a little bit more in this video. And if you haven't been a subscriber to this channel, please do click the subscribe over there. Would appreciate it. But we've been talking about this in some prior videos, but let's go over this again. It's FDIC insured, right? The FDIC only has $125 billion to insure these banks, even though there's over $22 trillion in the banks. Now, anyway, I digress. But say you give them this money here. They go, thank you. I appreciate you giving us this money here. We'll go ahead and give you pretty much nothing in return. But you can use our app. That'd be nice, wouldn't it? Don't you want to use our nice, handy-dandy app? We'll give you 0.0000001% for your money. And that's how it used to be. So they would basically go, thank you for letting us hold all of your hard work. We'll go ahead and put like this much in our reserves. And then we'll take this much of your money and go invest it elsewhere, right? That's how it works. Now, what happened that was very interesting is with Silicon Valley Bank in particular, and this is going to happen probably to more banks out there, just a YouTuber saying that, not just putting that out there, just my opinion. But let's go back to this video, not this video, but this screen here real quick. So basically the banks put this much in the reserves of your money, your roughly $200,000 or whatever this is, and go say, okay, we'll put about 10, 20 grand in the reserves here, if you're lucky, probably less than that. But that's what they're going to do. Then they're going to take this much and go, we want to make some money on this money. This person is trusting us at the bank with this much of their hard work. Let's make some money off this money. What's something very easy for us to do that requires little to no effort by the bank but makes us a ton of money? Oh, well, we can go to treasury bonds. We'll go and look at these 30 years here. And this is back, you got to put it into account, this is back in 2020. So in 2020, when the interest rates were really low and all of that, they went, we can make a guaranteed 1%. Let's lock up their money for 30 years. We can make a guaranteed, 2, 3%. Let's go lock up their money for 30 years. That's what they did, right? Now, what they didn't take into account was that the Fed was going to do this and raise rates. So there's this tightly coiled effect of having money pretty much for free, and they thought it was going to continue being free money for everybody for a long time. Now, interestingly, we have never seen this tight of a coil before. Let me move myself out of the way. We've never seen it be at zero for this long, or not zero, but pretty close, and giving away all this free money for so long. We haven't seen that. And now that tight coil effect of giving away all this free money is coming into account because now as they raise rates, there's more competition out there. So what that basically means, go back, that basically means is the bank that you might have trusted in 2020, which in this scenario is Silicon Valley Bank, they went and invested your money in a locked up bond when they thought it was a good idea, and they're only making 1% or 2%. Now, what they didn't take into account is that the Fed raised the rates, so now the competition is happening in the banking system. Now you can make more money off of these bonds, right? So what people are doing are going, hey, Silicon Valley Bank, remember when I gave you all of this? Can I have that back because there's better opportunities out there and you're not really giving me any interest? Like most banks barely give you any interest. You trust them with all of your money. They give you not even enough interest to compensate for anything really, let alone inflation. They don't even give you like 1%. But now things are a little different. Now when we go back, you go to your bank, in this case, they go to Silicon Valley Bank and they go, wait a minute. Just the 30-year treasury is paying me around 4% now. And you're not giving me any interest on my capital. I have a lot of capital with you, Silicon Valley Bank. So please go ahead and give me this money back. I'd really appreciate it. Now, more and more people start to do that. And as the Fed continues to raise and raise and raise the rates, there's more competition for people that want to hold your capital. People are going, wow, the cost of money is very expensive. If the cost of money is very expensive, then people are going to basically turn around and go, hey, can we use your money? We'll give you more of a percentage because it's harder to get money now if we can use your money. So because of that, you're going to see more and more free market competition happening among the people that want to hold your money, which means more and more people are going to withdraw their funds from the bank and try to find these better rates, especially if they're worried about inflation. If inflation is this high, people are going to go, wait a minute, how much money are you paying me? How much interest are you paying me on my capital? And that's why we see this terrible scenario of more and more people are going to want to pull their funds out and find better investment opportunities. The problem is, here's the big problem, is so many of the banks took your money and invested it elsewhere, and they only have this to show for it. So when you go to your bank asking for the entire amount you gave them, and they only have this if you're lucky, that's a very rough scenario. But it gets even worse because the FDIC only holds $125 billion. So who is going to bail out these banks? And where is all of this money? What's going to happen when the market opens? Oh, and better yet, why are the banks all shut down on the weekends? It's our money. Why don't we have access to our money 24/7, 365? If I want to send a wire transfer Sunday at noon, that's my prerogative. Why can't I do that? I don't understand that. I don't understand why they're all shut down. That's interesting to me. So we're going to see how the market opens tomorrow, but I wanted to break down exactly how this works in this video. If you found some value in it, I'd really appreciate you hitting the subscribe button. Also, sometimes the algorithm doesn't like to put me out there. I'm trying to do a little bit better with getting into the algorithm here on YouTube. So please do subscribe and hit the like button if you found some value in this video. But please follow me on my social media here on Instagram as well. Rob Sultan on Instagram, if you could do that, would really appreciate it. I always usually will put in my story when I drop a new video. So if you want to know more about me and the things that I do for work and all of that, shoot me a follow on the IG, and then you'll also get a notification by just checking my story from time to time there. Thank you so much for watching this video, and I will see you at the next one.